Well, joining me now for a closer look at Ben Bernanke's comments and the US economy is Philip Poole from Global Asset Management. Thank you very much indeed for joining us today. Ben Bernanke talking there, really talking about domestic issues, not surprisingly, about jobs and slower growth, and justifying QE2. But QE2 is something that's going to have huge international implications, isn't it?
Absolutely, yeah. A lot of that liquidity will simply leak out of the US, and it's obviously bidding up assets, particularly in the emerging markets and currencies as well. So, in a sense, the US is reflating a large part of the rest of the world without, likely anyway, having much of an impact on the US economy itself.
And now what's also happening, we've seen today interest rate rise in Thailand, but, you know, we're getting this wash of inflation issues in some of these emerging markets, and presumably that's not going to be helped by this.
Absolutely. I think investors really should be looking to get some inflation protection in the emerging markets at this point, so look for some of the inflation-linked bonds, for example, but also asset prices. Asset price inflation is one of the issues. So really, I think there's a lot of concern at the moment, obviously, around Eurozone peripheral issues, risk-off in a sense, but I think the risk-on trade comes back on the back of this liquidity, and emerging market assets will benefit.
Now, we've got non-farm payrolls coming up at the end of the week. It's too early, really, isn't it, to tell if any of that QE2 will have actually made any difference at the moment to what's going on internally in the US?
It is too early. I think, though, that the non-farm number will probably be broadly in line with what we've seen, actually, for the last few months. There is clearly a drag on US employment coming through from local authorities, from states, as they cut jobs. But the private sector, actually, has been adding jobs. But I don't think we should look to see a significant fall in US unemployment. It's going to be relatively sticky, I think, around current levels.
And now, if we look at what's happening across the peripheral countries of Europe, we're seeing this contagion, and we're hearing now that the European policymakers may have to do something more to try and prevent it. Do you think it's going to take a bigger measure than just these individual bailouts?
I think what's happening really is we're seeing the repricing of the credit spectrum in the Eurozone, and that's reflecting, in a sense, the idea, or the previous idea, of this umbrella that once you're inside the Eurozone, it doesn't matter what your policies look like. I mean, that is clearly dead, that idea. And so that repricing, I think, is an ongoing issue. All of the measures we've seen so far have been liquidity-related measures. The market is thinking more about solvency questions now. So I think if we think in those terms, really, we can see more liquidity measures from the ECB. We can see additional loans, for example, coming through. But in reality, the solvency issues remain. The problem's, in a sense, just being pushed into the future. Right.
And at some point, does this have much effect worldwide? I mean, I'm not talking specifically about a country like Spain, but in general, what are the implications for the sovereign debt crisis as far away as the United States, but also the emerging markets?
I think what it's doing really is reflecting the fact that fundamentals really matter, fiscal fundamentals in particular in this case. And so, in a sense, really, it's a healthy correction that people are focusing on those fundamentals, thinking about debt levels, debt sustainability. Clearly, it's a systemic issue. It's impacted risk appetite. It's impacted assets across the board. And I think it remains an issue in the background. But to my way of thinking, this liquidity that's coming through will probably take over at some point in the reasonably near future, and we'll see markets rebound.
OK. Philip Poole, thank you very much indeed for joining us. Thank you.